After some better than expected numbers on the CPI, we saw a really nice boost this week going into Friday where we pushed over the 200 simple moving average. But we're running into some resistance that Riz and I are going to talk about on our market recap webinar. Good evening, my fellow Riz Elite members and all of our subscribers on YouTube. Welcome to our weekly market recap webinar. My name is Chris. I'm part of Riz International, and we are a group of traders who are looking to better ourselves, to help further educate people about the markets and what to look for. And there is none better, in my opinion, than the man himself, Riz Memon. Riz, how are you doing this evening?
Doing good, Chris. Thanks for having me on. It's good to be back. I believe this is my third, fourth maybe webinar in a row. So that's a
Yeah.
good track record for me at least.
You have been on it consistently, and that is awesome because we really value your opinion. And, as we can see this week, there was a little bit of trepidation, kind of going into the numbers release on Wednesday. And I would say that although numbers were pretty much in line, they weren't necessarily really all that much better than expectations, but they were right at expectations. And obviously, the market saw that as a rather positive thing. If I had to guess, the fact that it wasn't bad or it wasn't worse. And we saw a nice little run up into Friday, but we closed right below this critical support level of 4,000, as well as my downtrend that has been respected so far. We'll have to see if that continues moving into this week. But Riz, it looks like we've got a lot of momentum going into, well, not Monday because the U.S. markets are closed on Monday for MLK Day, but Tuesday. Obviously, we've got some momentum going up. Do you think that this will be sustained, or do you think that maybe we might peter out a little bit and get some profit taking here?
Yeah, I'm expecting a little bit of profit taking. We have this week as a short week, as you mentioned. Um, so usually shorter trading weeks, we see a little bit less volume. And now that the CPI data has come out, uh, all eyes are going to be on earnings. So this week also kicks off earnings. We have some uh, big names, just to start off the week. I think we can touch on that in the later part of the webinar. But I do have my list of key stocks that are releasing earnings, and that'll be interesting. And once we really get into full blown earnings, not this week, but the week after, that's really going to dictate how the market feels about all things corporate earnings, revenues, guidance. How are things looking from a corporate standpoint, from a business standpoint? Are these companies we know are continuing to do layoffs, job cuts? I think that's a theme for 2023. Really, no matter where you stay, I think it's a common theme, especially in tech. We know that. But from a technical standpoint for the market, like you said, very much up against that resistance line there, the trend line downward trend line. And I would say even that 200-day moving average is kind of acting as a resistance. We've seen it creep up before. We've seen in December the market push up above the 200-day moving average. We've seen it multiple times before in 2022 as well. So I don't call this a clean break just yet. What's interesting to note is that the RSI on the market is also getting, it's not overbought yet. It's not completely in the realm of excess, but it's getting up there. You could see that big move up. And take a look at the last time we had a clear breach into the overbought area, and that was in August, if I'm not mistaken. As Chris is perfectly circling these, amazing. Thank you. You could see the market puked from a technical standpoint. So we have a few things I want you to note down. All right. One, trend line, downward trend line, resistance. 200-day moving average, resistance. RSI approaching, not yet, but approaching overbought. Okay. I want you to now think, and not you, Chris, but the viewer, sit back and think after this webinar, after you watch this video, what I'm telling you, right? I don't like to really, and I find this is a conscious effort on my part. I don't want to no longer tell people what to do. They can look at what I do. They can see and hear what I say, and then they can come to their own conclusions, right? I think it's important, especially this year, to kind of make that shift where we want people to be self-sufficient, Okay, whether you are in elite, whether you're watching markets, whether you're watching these webinars live with us or recording or on YouTube, self-sufficiency is important, right? We're there to help you and guide you, but uh, like I said, I nor Chris, from what I know at least, we can't tell the future, right, Chris?
I have not been successful at that just yet. I'm still working on it though.
I mean, I do have a crystal ball laying around on the side that I like to shine up once in a while, but with any level of consistency, time and time and time again, the more the sample size, the less the chance of being right. And that's the problem with being able to tell the future. It's not viable for us mere humans. So let's see how that goes. But to not spell it out for you clearly, we can see there's quite a bit of things working against the market in terms of a technical standpoint.
It's a really good point that you made there, Riz. We have to work on becoming more self-sufficient as traders because you can't have somebody there holding your hand the whole time. And that's really what we're trying to do here is we're trying to teach you how to look at these things. We're letting you know what we're looking at so you can look at it as well and make your own conclusion. But one thing that I am going to hold your hand on is you need to get down there. Make sure you click that like and subscribe button down just below the video. We'd really appreciate you helping the channel grow that way. That really helps out quite a bit. All right, let's take a look here at what the market is doing as far as the different sectors are concerned. So we've hit on this last week. I've got it set up for the 1 year because if I put this on year to date, we've got like feels like about 5 trading days of data. I know it's a little bit more than that, but it feels like that. So the chart isn't all that helpful just yet. But, kind of looking here over the last year, we know that energy has just been going hog wild, for lack of a better term, just been tearing it up at this point. And, you see here utilities and healthcare starting to creep back up into that positive area. We've got our consumer staples that, really kind of holding their value, which makes a lot of sense because, well, they're staples. It's your eggs and chicken. And I know there's a lot of memes going around about right now about the price of eggs. Maybe I'll flash one of those up on the screen in the recording. But, for the most part, of course, staples are down a bit, but holding pretty steady while we're starting to see a little bit of an upturn here in the S&P 500, and it's bringing these other sectors up with it. We've got financial starting to see some life, real estate, tech are starting to perk up, and even consumer discretionaries and communications are starting to trend upwards as the market continues to push. You were talking about earnings, Riz, and I know we'll take a look at some of those bigger ones, kind of moving forward here, and how much effect are you feeling like these earnings are going to have on the market? Is it really going to give us that boost that we need if things are in line or looking good? Or, will it be more centric on each individual sector itself?
Yeah, well, I feel like once we see some of these companies, again, this is just a shorter week. We're just starting. We got some key players, but the big guns come out next week and the week after. So although there are a couple of names that are big, they can kind of skew the sentiment leading into the week after. But it's important to kind of go over, and I'll be paying attention to the kind of the remarks and the transcripts from some of these companies. I'll mention them later on in the webinar, but they are going to be a little bit important to set the expectation. And once we start seeing the bigger names come out and what they say, that can definitely impact the broader market, not just any individual sector like tech or communications, but it can also impact the broader market. Financials are one we have banks also reporting. We have some big banks reporting. So what they say will obviously matter. So it's going to be interesting to see how that all factors in. We do know we see higher volatility during earnings season for obvious, for good reason. But I think all eyes are going to be on what CEOs, what management is saying about, the health of their company, their workforce, their costs, and future expectations for revenue and bottom line, which is profits, right? So the market's going to be looking at that. They're going to be paying attention and seeing what these top large companies have to say.
Yeah, I mean, definitely guidance has played a really big role in earnings, at least for the last couple years, in my opinion. It seems as though people are really, it's nice to have that good EPS, especially if you beat the earnings per share and things like that. But really, it seems like guidance is kind of pushing these moves a lot more, whether, they're looking maybe things are looking bleak, and there'll be some contraction in their area, or things looking great. Like, yeah, we should expecting to make more money this year or this next quarter, and that obviously is viewed fairly positively. So it's definitely something to keep an eye on. It's one of those things where like sometimes earnings are up and yet the stock goes down, and I think a lot of people kind of get confused about that.
Yep. Yep.
All right, let's take a look at some asset classes here. We'll start with our favorites first, which of course is going to be oil and gold. So oil has really just kind of played with this 76 area, and it's really holding steady here, looking like we closed on Friday. Let's see. That was right at about 79.50 per barrel, which is, a pretty decent area, especially when we're up here in the 120s early last year when everything kicked off over there in Eastern Europe. So oil has really stabilized quite a bit, in my opinion. We've seen this nice slow decline, kind of pulling back towards what's more, a viable price point for oil. I know, Riz, we don't have any positions in oil right now, and I'm not going to, tell people what they should or shouldn't do, but obviously, oil is kind of hanging out down here. I don't really see a whole lot of movement. Are there any catalysts we need to be aware of for oil here coming up?
No, just the usual, weekly stuff of inventories and whatnot. But yes, I think from a technical standpoint, this is looking nice for a potential long. Now, I'm not saying you go out and buy as usual. I'm just giving you my insights of what I see. No position yet, as usual, as you said, Chris. Just watching and waiting. But I think the fact that it found a nice base around that 70, 72 area and bounced up from there, that tells me, okay, the market, feels like, okay, this could be a nice level, barring any unforeseen circumstances, unless OPEC starts, talking about some price cuts or sorry, production cuts, then that will, that could impact it positively, could send it up, but nothing on the horizon that I know of for now.
Well, that's definitely good. It's a good thing to know. So we just kind of keep an eye on what OPEC is doing. And one thing that, in my opinion, does not look good for long right now is gold, because gold is going absolutely nuts, for lack of a better term. Ever since we kind of hit the bottom here, this 1630 area seems to be pretty important for gold. It has really rebounded off there and is pushing up really high, really fast. This is quite impressive for gold. Riz, what do you see is going on with this? This kind of run up has been a little
Yeah.
unprecedented as of late.
Yeah, we're seeing a lot of institutions. I mentioned it last time. A lot of institutions have gotten in. A lot of CTOs, which are essentially commodities trading firms, gotten in probably as a hedge, as a diversifier. So it will pull back eventually. I'm just wondering how high can this thing go, and obviously how fast it can get there. So we don't know that yet. I wouldn't be coming in and shorting just yet, personally. We have seen, gold, in last year in March get to that 2040 per ounce level and then hard reject. So waiting to see. I don't think we're going to get there yet anytime soon. I think it's going to slow down. This momentum cannot sustain itself. This kind of momentum from 1600 to now 1900, it's far too fast, and far too significant of a move. About a 17%, 18% move in what, a couple months. So that's big. That's big for an asset class like gold. So I will be keeping an eye on this. I know it sounds boring, but that's the honest truth. I'm not here to make it exciting for no reason. I'm telling you right now that I agree with Chris. Not a, in my opinion, not a good area to buy right now, unless you're a hardcore gold bull and you just really want to buy these momentum type of moves. But other than that, uh, I'm waiting to see where it can kind of find a ceiling, and then maybe play the retracement lower.
Yeah, that's really good advice, guys. Like, don't chase. I think that's really the big thing here. Is the last thing you want to do is chase a move like this, because this is when you get stuck holding the bag and you're going, well, hey, Chris, Riz, why isn't gold going up? Well, because you bought it at the top. So guys, just stay patient. Sometimes that's really the most important thing. If you're going to make money in the market, you have to be patient and time your entries. And at this point, yeah, I would not chase this on gold. Let's jump over here to some of our newer charts, and even this one, we added another, bond, a Treasury bond yield in here. Riz and I were talking about this right before the webinar started, and right here we're looking at, like I said, the Treasury bond yields, and The big thing right now, and we've touched on this on the last couple webinars, if you missed that, make sure you click back on that, click on the channel, click on videos, and go look about 2 episodes ago where we talked about what it means for the 2 and the 10-year bond yields to be inverted. But we've added here the 30-year bond yield as well. That is the teal line, just pushing right above the 10-year at this point. Riz, obviously these seems like yields are coming down a little bit for all of these. What are we seeing here? Obviously, this has a pretty good direct, relationship to, some things going on in the market. So what are we looking for here with the bond yields this week?
Yeah, so I figured we should add the 30. That way we get the full picture. By no means is it required, but this gives us a better idea and outlines what I've been kind of saying, how the market is now pricing in and kind of factors in a decrease or a potential rate hold. So it's factoring in not only a slowdown in the economy, but it's also saying, okay, the Fed might pivot. So we're at odds here. The Fed said we're not going to pivot. We're going to hold rates, maybe even raise a little bit. But the bond market is signaling something completely different. And more often than not, the bond market is usually more right than really what the Fed has to say. Go figure. But Chris, I want you to hit that 1 year button at the bottom there and see if that changes how this looks a little bit. There you go. So interesting here, the bond yields have been pulling back the last, pretty much all of 2023 and since December 2022. But they're actually ticking up slightly, a slight pickup if you see. So even though on Friday and Thursday and this past week as a whole, we had that very bullish, significant rally, bond yields are coming up too. So remember, usually bond yields picking up is a little bit of an inverse relationship. I don't want to say it's like one-to-one correlated. It's not always, but it is something that I've seen factor in more so the last 2 years than prior, where interest rates have really become a big talking point. We've seen these kinds of pickups in yields signal that maybe some risk is being taken off in the market, right? So remember, the bond yields are pretty much the risk-free rate of return. So if we look at it really, if someone didn't want to take any risk with their money, they didn't want to put in the market, they didn't want to, okay, is Tesla going to go to like $50 a share? Am I going to get railroaded? Is Amazon going to go any lower? They don't want to deal with any of that. Then the risk-free rate of return is the bond yields, right? They're pretty much one of the most secure assets uh, out there and essentially generating a return, not that significant, but return on your money. Uh, After factoring in inflation, though, it's still a real rate which is negative. So it's still a negative return, but at least you're combating that. So currently, annualized inflation is about 6.5%, and you can see by these bond yields, on a what is it a 10-year yield bond yield, you could get 3.5% annualized, right? Risk-free rate, and for a 30-year, you can get just about the same, which is absurd, right? And then when you look at the 2 year, look at that. The 2 year is a little bit higher. So everyone's kind of piling into these 2 year Treasury bonds. A lot of people are getting into these because they realize, well, this is a good hedge. It's not going to completely hedge out inflation, but it's a good hedge. Uh, Plus, it keeps us relatively secure. We know one of the best asset classes last year was cash, right? Even after factoring in inflation of around 7-8% last year, it was actually cash that outperformed the market last year, right? So something interesting to keep an eye on. If we continue to see bond yields go up, just like that little tick we saw the last few days, you can assume that we could see a little bit of a sell-off in markets.
Always good to know what leading indicators to kind of take a look at here as we continue on with a rather volatile year so far, going into earnings season, no less. And you're talking about cash, and yeah, you look at the value. Excuse me. You look at the value of the dollar here, and it's definitely was running up last year, but we've seen a very kind of sharp decline here starting in November, and we're talking that this is actually kind of a good thing for the economy that the dollar is a little bit weaker right now. It's kind of running a little too hot. And yeah, things have definitely been coming down since we've been having these higher interest rate hikes. And yeah, I know there's definitely been talk about some cooling off as far as the speed and the rate of these rate hikes are concerned. I know, Riz, you're saying that the Fed was saying, oh, maybe we start slowing down. Is that something that really makes a lot of sense at this point? Wouldn't it make more sense to kind of keep interest rates going to drive this inflation down a little bit more, or do you think that this rate on the decline of the dollar is right about where they want it?
Yeah. So again, the Fed doesn't really care about how strong the U.S. dollar is as relative to other global currencies. But yes, if to answer your question, I do feel like the Fed needs to hold rates, maybe even raise a little bit more. And I know that sounds counterproductive because that would mean that more often than not, the market is going to get a little bit spooked and go lower. And people are probably thinking, well, that's blasphemy. What are you saying here? But in reality, it comes from a selfish reason, but also a greater good reason. So from a selfish reason, it's because I'm in about 80, 85% cash right now. So it goes without saying, I would welcome a further drop. But from an overall economic and greater good reason, the Fed needs to still, I would say, siphon out some of that excess. That's some of that uh, heat in the economy. It's not there yet. I still see quite a bit of, it's pulling back. Like, we see car prices, house prices, jewelry, we see all that stuff pulling back. But many areas of the economy are still pretty strong. Jobs numbers are still strong. Unemployment still low. We can't have a sustained cooling of the economy if those metrics are still high. So I feel like the Fed still has some work to do. It's a good sign that we're seeing CPI inflation come down, but that's only part of the problem. The other part of the problem is this economy continues to remain very resilient, and it's important to have a cool off because if we don't have a cool off, we get into these crazy boom and bust cycles, and that's really what the Fed's in charge of avoiding. So that's their job to make sure we don't get these crazy booms and bubbles and then, you know, potential bursting of that bubble, which eventually ends up being like a big crypto cycle, right? No one wants that. So uh, it's interesting to see how things go. The US dollar pulling back relative to other currencies is about in line. I didn't expect it to come down this fast, but here we are. Again, nothing like we're not something we're trading directly. It's just something to keep an eye on because a lower US dollar is relatively good for other broader economies and the US, so long as it's not too high. I would argue, in September, October, it was a bit too strong for anything to do with manufacturing, production, exports, and imports. So otherwise, this pullback is a bit good for manufacturing.
Always good to know how the dollar is being represented against other currencies to get kind of an idea of what's going on. Moving in this week, obviously we talked about earnings being the big thing to look out for. And I think we're going to talk about that here in a minute, but just a few things to keep an eye on here this week as some important dates. Obviously, Wednesday, we have the PPI month on month, for December coming in as well as retail sales. So I'm guessing we're probably hoping for some big numbers in retail sales. I heard there was some, holiday there, but it looks like they're expecting to be in the negative. So that's going to be something to be interesting to keep an eye on. I guess people were doing a lot of their shopping on Black Friday. And then we've talked about building permits before, on here and what that means for construction and things like that. But yeah, Riz, in my opinion, I think the big thing to look at this week is going to be earnings, unless there's something here that I'm missing.
Yeah, so PPI, Chris, is the producers price index. So it's
Correct.
kind of like inflation, but for producers, the manufacturing side. So obviously that's a different number compared to core CPI, which is a consumer price index. So that will be interesting. It's not as important as the actual CPI, but it is still something that the market keeps an eye on, and it's still relatively important. Retail sales are more important, I would say, because this gives us a glance at how the average consumer in the U.S. is kind of using their dollars. Are they still shopping? Are they tightening up the bootstraps? Are they tightening up that belt and wallet? And for now, it seems like they have a little bit, but from what I've seen, Amazon still had a record Black Friday. So did many other retailers online, especially. There was a significant amount of online shopping compared to the last 2-3 years, obviously. Um, so that number will be important how things go in that sense. And then to cap off the week on Thursday, building permits, housing is essentially telling us, are houses being built? How many are being built? Are there more or less? This is another metric that can signal a slowdown in the broader economy. The weaker the economy gets, the less construction that occurs. New housing slows down. I'm not saying no houses are being built ever, but it does slow down. So this is a leading indicator as well to keep an eye on.
All good things to keep your eyes on. But yeah, Riz, let's talk about earnings a little bit, because you had said that there were some things that you were going to be keeping your eye on, obviously, for some sectors and
Yeah.
different
Yep.
things, big names that are reporting. So, what are we looking at this week for
Yeah.
earnings?
Couple banks. One being GS, Goldman Sachs, everyone's favorite investment bank, um, so to speak, and they've had a nice run up in 2023. So this will be interesting to see. If you see their estimates, amazing uh, numbers. To be honest, they've done quite well the past year in their earnings numbers, and of course they provide a little bit of a dividend as well. But reaching a bit of that overbought level on the RSI. So that'll be interesting to keep an eye on. That's going to be on watch. Morgan Stanley, MS, is another large, big bank. And same thing, they too have been running up in 2023. Again, they have some stellar numbers coming out and they've done well. Most banks have done well the last year with, uh, one miss there for Morgan Stanley in July. But other than that, they've done well. So important to see what they have to say. Uh, Next, we have something that's very much not a bank, and that is Netflix. Netflix actually releases on Thursday after the close, whereas the banks release before the open on Tuesday. Okay, so Netflix is obviously a bit of a mover the past few months in a nice upward trend, right? A classical upward trend, respecting those moving averages and using them as support. That's really what we want to see for an uptrend. Uh, Thing is, getting right up to that 331 fill, really filled that gap from last May. Now we're also overbought on this. Of course, you mix that in with the earnings catalyst, and boy, oh boy, you're ripe for a pretty volatile move in that. So again, it'll be interesting to see. For those that know, I avoid playing earnings, and I say the word play, uh, with intent, because really you are really playing on, uh, literally playing a game where it's a 50-50. Because unless you have some information that others don't, uh, it's really a coin toss with how they go. And not only that, it's a coin toss how the market reacts to them. We've seen sometimes earnings come in miss, but then the stock holds up right well. We've seen earnings come out well, do good numbers, but the stock tanks because the guidance wasn't too good. So remember, it's very much a knife catch in these kinds of situations. Either you look like a hero or you look like you are an idiot. So that's a core facet of playing earnings. So I usually avoid them. They're pretty uh, uh, I would say better off just taking your odds at a roulette table. Okay.
Yeah, I have to agree with you, Riz. Looking at this over the years, it has been incredibly difficult to, find a rhyme or reason to earning sometimes. And like you said, if you nail it, you nail it. But if you don't, you kind of feel pretty bad about it, to say the least. And so it is, oftentimes you'll see sometimes, a bit of a run up going into earnings as people are closing their positions. And people are kind of jumping on it, expecting a run up or a rundown, depending on the direction that you kind of see that buying or selling going. But yeah, earnings are definitely a tricky one to play. I want to go ahead and request that people start posting their questions in the chat for everybody who is here live. Were those the three that you were kind of keeping an eye on this week, Riz, for the most part?
Yeah, no, these are the three. Again, earnings season's kicking off, short week too. So there's obviously definitely other companies, but they're not something that I'm too thrilled about looking. Like I don't really care about looking at like the Bank of Ozark or like Key Bank. Like there's a lot of banks, smaller banks, national banks releasing. That not really my cup of tea. So I've kind of picked the two major banks releasing on Tuesday before open, and of course Netflix being the big one. Actually, one other actually that's I actually missed. Good thing you asked, Chris. PNG, Procter and Gamble. This one releases same thing with Netflix Thursday, but before the open. Okay, so this one is a stellar stock, amazing stock, one of the best, consumer staples companies you can own. And you can see that from October onwards, as the market lingered lower and volatility, this baby just kept chugging along. Doing really well with their earnings, solid dividend. What more could you ask for? Very, very solid, amazing company. And I am willing to wager you at some point use some of their products at some point in your life, throughout the day, even. So, yeah, let's see how that goes as well. I feel like I'm not going out there and buying it, but it's definitely gonna be interesting to see their earnings. I wouldn't be surprised if they do well. Uh, I don't think this kind of consumer staples sector, as we've seen, um, which has been holding up well over the last year. And Johnson and Johnson is a perfect. Procter and Gamble is a perfect example of that. Holding up well, and you could see that from 2022 onwards. Chris, how low is it from the highs? I think not too much, not too bad. Only 8%. Look at that, right? Whereas when we look at the S&P 500, probably about 15%. And when you look at other tech stocks, ooh, that's bigger haircuts there. So this goes to show you a defensive stock at its finest.
Yeah, looking right around 17% for the S&P 500 at this point. So, those staples doing a little bit better, as you mentioned. So definitely a little bit of a disconnect there, obviously which is good for PNG. And if you hold them, it's definitely a good thing.
Yep. Awesome. Well, I guess that's it. Not too many questions coming in, so that's good.
Yeah,
In the sense that people are probably feeling pretty good, hopefully well rested as we head into the last day of the long weekend, especially for those in the U.S. And then Tuesday is going to be off to the races.
definitely. So make sure you keep an eye on that. And if you haven't done so already, like I mentioned earlier, click that like and subscribe. Join us here on the channel so you get alerted every time we upload a new video. We are doing these these market recap webinars every week for our elite members. And if you want to be in elite, if I'm not mistaken, Riz, we got some important dates coming up for that here fairly soon.
Yeah, so we are opening Elite again on the 24th. That's going to be the exact day. So, if you're not in, man, I gotta ask you, what are you doing with your life? Right? No, but seriously,
Right.
you gotta check it out. Gotta check it out. It's gonna be, I could tell you right away, it's gonna be less than a cup of coffee to get started. Just join, get all full access, get access to everything. Because I want to, at the start of the year, I want to make sure keeping barrier of entry low, give everyone an opportunity to join, see for themselves, the immense value. There's a reason why we have 5-star reviews. We have everyone ranting and raving about not only the master classes but Elite. It's a fantastic community, and I know I may be biased, but I can tell you very seriously and sincerely that having seen other things, all kinds of stuff over the years, I'm very, very happy and proud of this community that we've built. It's absolutely top tier and nothing less. And I wouldn't have it any other way. So, Chris, you'll probably link it in the bottom in the
Oh, definitely.
description somewhere. The wait list is open. Join the wait list. You get first dibs to join because obviously we do control the inflow.
Yeah.
Anything like anything good in life, it needs to be proper supply and demand, right? So in this case, yeah, we do limit numbers, not from a nefarious standpoint, but solely to make sure that we're not overwhelmed. The team is not overwhelmed. We have a good sizable amount of members that can collaborate, we can look after everyone, we can talk with everyone, answer questions, so no one really kind of falls through the cracks or feels, um, you know, pushed to the wayside. That's why we actually limit our numbers, unlike all these other garbage trading rooms, so to speak, who have thousands and thousands of members just to try and just use it as a little feeder, and where everyone just spams and just ends up being thrown to the sharks, for lack of a better word. So that's not what we're about. So yeah, it's gonna cost less than a cup of coffee to get in there, try us out, and I hope that you will really see the value and stay.
There you have it, less than a cup of Starbucks, and I can promise you the value that you will get from that skipped Starbucks will be considerably higher than what you would get from the coffee. So make sure you get in on that wait list. We will have the link down in the description and in the pinned comment. Thank you again, Riz, for coming out, and we have an amazing community here. Come and join us. We'd love to have you.
Awesome. Thank you, Chris. Thanks everyone for joining.
Good night, everybody, and we'll see you in the market on Tuesday.